Hey, welcome to this review session. So me and Justin, we prepared something. So firstly, we're going to go over chapter 18, just over some of the practice questions. And then we wrote our own notes on chapter 20 and chapter 21 to hopefully get you guys ready for this upcoming exam and answer all your questions. Let me share my screen.
Yeah, so we'll do chapter 18 first real quick. And then for chapter 20, I have a few things prepared. And so we'll just go over some of the analytical questions, but like I said, I always post the solutions to all of the practice questions onto Canvas, so you can also look at those as well.
So the first question should be kind of easy. It's which of the following both reduce net exports? So net exports is basically just exports minus imports. If you remember correctly, net exports is also sometimes abbreviated with an X, and all you're trying to do is make this number go up. No, actually down. You want to make this number go down. So basically, if exports fall or imports fall, that's going to make this number go down. I can also make a numeric example. Let's say net exports nx equals 5 minus 3, which means in that case it would be 2. Like nx, in that case nx would be 2. However, if exports decrease, which would be nx equals 4, do you see how this decreased by 1? And imports increase by 1, which would be 4 minus 4, and x would be 0. So overall, nx decrease. So either decreasing exports or increasing imports will make this variable go down. Once you see that formula and think a little about it, it should not be too difficult of a concept, but it's a very important concept. Because this is the only variable that's kind of dependent on two inputs. Number 3, we're talking about net capital outflow. We're given if domestic residents of the countries purchase 600 billion of US assets and US residents purchase 500 billion of foreign assets, the US net capital outflow is. Remember, net capital outflow is very similar to net exports. Later, you'll see that we're actually setting them equal to each other. So the formula is purchase of foreign assets minus purchase of domestic assets by foreigners. So it's very simple, 500 billion minus 600 billion minus 100 billion, and they have a trade deficit. Another one is which of the following equations is correct. So first, remember the normal equation, y equals c plus I plus g plus nx. Literally in all 3 chapters, you guys just need to know this equation, which is for aggregate demand equation. It's also the GDP. Very important. However, this is equal to saving. Basically, the GDP minus consumption and minus government spending. Here I abbreviated it, and then is equal to I plus nx. And we're basically just setting nx equal to net capital outflow in this case. That's why C is the only answer. For number 7, we're asked during some year a country had exports of 50 billion, imports of 70 billion, and domestic investments of 100 billion. What was saving during the year? It's again, do you see this? S equals I plus NCO. And remember, NCO is nothing but an X. So this is the formula given from the last question. And you basically just plug in 100 billion for investment and 50 billion for exports and 70 for imports, and that should give you 80 billion. So it's very easy if you know this formula, just reading and plugging in, plus minus, no complicated math at all. Here again, one where it's basically just memorizing the formula and applying it. They're saying if the real exchange rate between the US and Japan is 1, the nominal exchange rate is 100 yen per US dollar, and the price of chicken in the US is 250 per pound. What is the price of chicken in Japan? You could probably also write this formula on your own if you really think about it, but I just basically wrote it down in the correct form and what they're really asking. Um, so here is the formula: real exchange rate equals nominal exchange rate times the domestic price divided by the foreign price. And you're basically just solving for this price foreign because they're asking you what's the price of chicken in Japan. All you do is basically multiply the price foreign times real exchange rate. But remember, the real exchange rate is 1, I believe. Yeah, the real exchange rate is 1. So that's why I forgot to add that. Maybe it would be 1 times price foreign. And then you basically cancel out here this US dollar and US dollar, and you multiply 250 times 100, which would give you the answer of 250 yen per pound. Well, the last question I'm going to do before I'm going to hand it over to Justin is, other things the same if the US exchange rate appreciates, US networks and US net capital will both decrease. So this is a question I'll answer with the help of, I'm giving an example which made me understand this concept. So I don't know if you're aware, but a lot of times in the media you hear about, oh, China is trying to keep its exchange rate low artificially. And why would a country try to keep its exchange rate low? The reason is, if your exchange rate is low, people will buy from you. You will be able to export more good. Think about it like this. If you're an American and you visit a maybe developing country, you're told like, oh, you're so rich, like you trade your dollars for the local currency, and then all of a sudden you can buy so much more for your money, and you're like, I'm rich in this country just because your dollar is so much more higher than the local currency. However, if you're a producer of, I don't know, you're a farmer in one of those countries with the low exchange rates, you're not going to go and buy these American goods because these American goods are going to be so expensive for you. So that means that if the dollar appreciates more, they're going to have even more trouble selling these American goods that are now even more expensive relative to the other countries. So that's why exports will decrease. And if we remember, if exports decrease, net exports in total also decrease. So that's why D is the only correct answer for this question. And just like understanding these concepts will make it really easy.
All right, so I'll take it from here and I'll do a few of chapter 18 as well. So I think what Alex just said there, that's actually kind of a big concept. And this kind of feeds into the number 11 question, is talking about this idea of what happens when a currency gets stronger to the trade deficit. So for instance, let's say that the Mexican peso gets stronger relative to the dollar. So that means that it's at a higher value than what it was at before. Well, what's going to happen to the trade deficit? So if the Mexican peso is increasing or it's getting stronger in value, then that means that imports to Mexican citizens are going to seem cheaper. So therefore, they're going to want to import more goods rather than export more goods. Now, on the contrary, uh, in that case, US goods are going to seem less expensive. So therefore, Mexican citizens might buy US goods, which would increase the exports for the United States, but would increase the imports for Mexico. So in that case, for the US, their trade deficit would start to fall, or basically what that's saying is their exports would increase relative to their imports. So that idea of, you know, what is going to happen to a when a current what happens with a currency devaluation or a currency appreciation with net exports is kind of a very big concept. So I would definitely, for the exam, understand what Alex just said about uh, the change in currency, uh, or the change in the exchange rate, and how that affects net exports. So I won't go too in depth into the rest of these, since a lot of these are kind of just uh, a continuation of what Alex said. So Say number 13, the real exchange rate is the nominal exchange rate defined as foreign currency per dollar times what? And that's going to be US prices divided by foreign prices. Remember up top, that real exchange rate that Alex talked to you about. It's always going to be whatever the nominal exchange rate is, and then it's going to be times whatever the domestic price. So whatever country you're looking at, that's going to be the domestic country divided by the price level in the foreign country. So there's a few questions on there that are very similar to that. Now, this one says if the nominal exchange rate E is the foreign currency per dollar, the domestic price is P, and the foreign price in P, then the real exchange rate is defined as what? Same as the last equation, E times P divided by P star, where P star is foreign price and P is the domestic price. So that's just kind of just knowing that equation. So I would just say, like, she's not really going to try to trick you too much on the exam. So make sure that you know some of these equations. Now, for some of the analytical questions, let's say if the exchange rate is 70 euros per dollar, and the price of the MP3 player in Paris, so in France, is 150 euros, and the price of an MP3 player in the US is $150, then what is our real exchange rate going to be? It's nothing different from putting the domestic price on top and putting the foreign price on the bottom. So in this case, both of the prices are 150. So it's simply just going to be 150 divided by 150, and then you multiply that by 0.7, and that's going to get you 0.7 euros per dollar. So that would be the real exchange rate if we're looking solely at the price of an MP3 player. Um, I won't go too much over that question since I've already talked about that one. I think the last one I will wrap up on chapter 18 is number 19, or excuse me, number 20. So we have this table right here, and it's giving to us the currency per US dollar. So this is giving us like the nominal exchange rate with all of the following currencies. So we have Britain, we have Germany, Japan, Saudi Arabia, and Venezuela, and all of their respective currencies. And then we have the currency per US dollar. So what is that nominal exchange rate? And then over here, it's giving us a price index. So this is going to allow us to kind of convert this into a real exchange rate, right? You know, back from that original equation that the real exchange rate is whatever the nominal exchange rate is times the ratio of the price indices. So in real terms, US goods are less expensive than which of the following goods, or what goods in what countries? So how do you go about approaching this question? Well, since we know that we're looking at it with comparison to the US price index, we know that the US price is always going to be what goes on top of our equation, or what is the domestic price index. And also, given that it says currency per US dollar, we know that we're trying to look at the exchange rate um, relative as as US being the domestic country. So we know that 200 always goes on the top, and then simply we're just going to multiply this nominal exchange rate by the ratio of the US price index divided by the foreign country price index. So I've done that down here for you guys, where I basically put the nominal exchange rate and then I multiplied by the US price index. So the US price level over the foreign price level. And this is what I get for each one of the real exchange rates. I get 1.8, 1.11 repeated, zero point 0.8 repeated, and 1. So in real terms, we're trying to figure out that US goods are less expensive than goods in which of the following countries. So if we're looking at the UK, we see on a real basis that the prices in the UK and the prices in the US are the same. Same with Venezuela. The only two countries that have a real exchange rate of less than 1 are going to be Germany and Saudi Arabia. So what is that telling us? That the US goods are less expensive than goods in those countries on real basis. Whereas Japan, it would be US goods are more expensive. And in these cases, with the UK and Venezuela, that would be the same. So in that case, your answer would be B, just Germany and Saudi Arabia. So basically, you do all those calculations, you figure out which of the real exchange rates are less than 1, and whatever countries have a real exchange rate of less than 1, that would be your answer. Um, So that's it for chapter 18. Um, and now you want to go over chapter 20 or 20, chapter 20, Alex? You're on mute. I'm sorry.
Sorry, I'm muted. I forgot. Yeah, you can do chapter 20 chronological, and then I'll finish it off with chapter 21, and then
Mhm,
we're good to go.
mhm. So I'm actually gonna share my screen because I kind of put together these notes for you guys. So I think when I've kind of gone online and read, some of the discussions and whatnot, I think the aggregate demand and aggregate supply curve kind of trips people up a little bit. So I kind of just wanted to talk about that and basically why the aggregate demand curve is downward sloping. Just kind of give like a brief review of aggregate demand and aggregate supply. So the aggregate demand curve, when we're going to be drawing that out on a graph, we're always going to have the price level on the y-axis and output on the x-axis. And basically what that's saying is that as price level decreases, that our real GDP or output is going to increase, or the quantity. In this case, if we're looking at aggregate demand, then that means the quantity demanded will increase as price level decreases. And so there's three reasons why this curve is downward sloping. And the first one is very intuitive and very kind of easy. It's the wealth effect. So basically what this is saying is, say you have like $1 or you have $2 or however many. If you hold on to that money and the price level decreases, then that simply means that whatever nominal value you had, so say it was $5, is now worth more than it was before. So basically now your dollar's worth more, which means that you can buy more goods and services. So that means that the quantity demanded of goods and services is going to increase. And so that's why you get that. That's the first reason why this curve is downward sloping. The second one, which is a little bit difficult, is the interest rate effect. So this kind of has to do with when price level increases, lenders must charge higher interest rates to get a real return. Another way you can think about it is Alex is going to go over this curve a little bit later, the money supply and money demand curve. Um, so as uh, as inflation increases, the money demand curve is going to shift to the right, and that means that's because you're going to need more money to purchase goods and services as inflation increases. Um, so basically, if inflation increases, that means like a good that I would have bought in the past, maybe for $2, I now need $5 to buy that. So I'm going to demand more money for goods and services. And if the money supply curve is fixed, which we know that the money supply curve is just that straight vertical upward sloping curve, then that means that the interest rate is going to increase. And we know that our aggregate demand curve is given by this equation right here, that consumption plus investment plus government plus net exports. And we know that as the interest rate increases, that investment is going to decrease, or investment isn't going to be stimulated. When the interest rate is lowered, investment increases, and if the interest rate is raised, then that means investment decreases. So in that case, we would be moving from a point lower on the curve to a point higher on the curve. So, and then the last reason is the foreign trade effect. So this is kind of the idea that I was talking about earlier, that as the US price level increases, foreigners are going to buy less US goods. And the opposite would be if the US price level decreases, foreigners are going to buy more US goods. And so that has to do with the XN portion of the equation, the net exports part of the equation. But since we already went over that, I won't go too much into that because I have a few more things to say. So when we're talking about the long run aggregate supply, what this is kind of saying is it's kind of talking about that monetary neutrality idea, that it doesn't matter what the price level is in the long run, our output is constantly going to be the same. So basically at a price level of say 100, it doesn't matter in the long run because GDP will constantly be at whatever that long run output is. Now, the short run aggregate supply is a little bit different. And this is where you get into the sticky wage theory. is basically what that's saying is in the short run, prices do have an effect. So as the price level increases in the short run, then basically real GDP or output, that aggregate supply curve, we're going to be moving from like from here basically to this portion of the short run aggregate supply curve. So in the short run, price level does have an effect on the aggregate supply curve. Now there's two types of of possible gaps that we can be in. One is called an inflationary gap, and one is called a recessionary gap. So the inflationary gap, what that means is that the price level is higher um, than what than what we should be at. So that means that we have a level of inflation. So aggregate demand is greater than what aggregate demand should be at the long run aggregate supply. So that so that aggregate demand should be somewhere where or intersecting that short run aggregate supply curve, but we're actually at a higher point. We're actually at a point where the short run aggregate supply and aggregate demand curve are at a higher output, but we also have a higher price level. Where a recessionary gap is just the opposite. That's just saying that the aggregate demand curve and the short run aggregate supply curve are at a lower price level, but we're at if like I were to draw a little point from where those two curves intersect, the short run aggregate supply and the aggregate demand curve, we're at a lower output level. And then there's also the idea of stagflation, which that's basically saying that if the short run aggregate supply, if there's some shock to that and the short run aggregate supply shifts to the left, then that means I'm going to have a higher price level and a lower output, which that's the worst possible combination you can have. So say oil prices increase, that's a supply shock that's going to shift short run aggregate supply to the left because oil is used as an input for a lot of production of goods, but the aggregate demand isn't going to change. So basically, we're going to be at a point of stagflation. And then that's where you start getting into fiscal and monetary policy of, okay, well, how can we change aggregate demand or to get back on course? So in the long run, we have, without any sort of government interaction, what should happen is this. So say if we have I'm going to do this one first because it's the easiest to understand. So say we have an increase in aggregate demand, then we're originally at an inflationary gap. So we have a higher price level and a higher output. As the price level and wages increase, then input costs become higher. So for the producer, their input costs are going to become higher. Therefore, they can't produce as much. So they're going to have to cut back on supply. And then the short run aggregate supply curve is going to shift to the left. And when we see in the long run, what we're basically going to be at is at a higher price level and the same output. The opposite with a recessionary gap. So say aggregate demand shifts to the left, price level and wages go down. So that means that firms now can produce more with a lower input cost. That's going to shift short run aggregate supply curve to the right. And then we're going to be at a lower price level and the same output. But the final thing that I think trips a lot of people up is economic growth. So say, for instance, we have aggregate demand curve shifting to the right, and then say that there's some sort of technological increase that allows companies to produce at a more efficient rate, then we have a shift of both of the curves to the right. So aggregate demand would shift to the right, and then short run aggregate supply curve would shift to the left. And what that does is that shifts our long run aggregate supply curve to the right. And that's no different from saying that our PPC is increasing or we have some sort of economic growth. Now, in the possible case that the hypothetical case technology decreased, then yes, like with a shift to the left in aggregate demand and a shift to the left in short run aggregate supply, we could very well have a decrease in economic growth. But since technology constantly innovates, we don't really think of that too much. So I just wanted to go over that a little bit because I think that can trip some students up when it comes to short run aggregate supply and the ADAS curve. But I will now go to chapter 21 and go over just a few analytical questions, or chapter 20, right, Alex? Yeah, give me just 1 second. Okay. Okay, so I'm gonna skip a few of these, and I can go over them later if anybody has any
Yeah,
questions.
we already went over 30 minutes, so try to just really go over the most important ones because I also have something to do and we don't want to make this too long.
Okay. So from this one, this is kind of just an extension of like if the of what I just said. If the economy is in run equilibrium, so that means that we know that we have this long run aggregate supply curve. We're at a point on that curve. Then an adverse shift in aggregate supply. So that would mean a shift to the left in supply. What would that move the economy from? So what we're basically saying is that if this curve shifts to the left and we know that we're somewhere along this curve, then where are we going to be? So the best guess would be is to look at this curve, shift it to the left, and we see that we'd be at a point of C originally because we have to be somewhere along the long run aggregate supply. And then when this shifts to the left, so an adverse supply of shock, then we move from C to D. It wouldn't be if it was a shift to the right of aggregate supply, then that means that we would move from A to B. So that kind of talks about question number 15. In the short run, a favorable shift in aggregate supply would move the economy from what? And that would be A to B. If there's a movement from A to B in the short run, then the price level would decrease and also output would increase, hence bringing a favorable shift in aggregate supply. Um, Imagine that the economy is in a long run equilibrium, then perhaps because of improved international relations and increased confidence in policymakers, people become more optimistic about the future and stay this way for sometimes. Which curves shift and in what direction? That's going to be the aggregate demand curve because we know that increased optimism is going to lead to more investment. And that's going to shift the aggregate demand curve to the right because the aggregate demand curve, remember, is given by C plus I plus G plus net exports. And if investment increases, then the aggregate demand curve would shift to the right. In the short run, what happens to the price level in GDP? We know that if the aggregate demand curve shifts to the right, then both price level and real GDP are going to rise. And I kind of talked about that earlier on, so I won't go too much into that. Again, optimism in the long run, what's going to happen? The change in price expectations created by optimism leads to what? Short run aggregate supply curve shifting to the left. So when you have the aggregate demand curve shifting to the right, you're going to intersect with a certain point on the short run aggregate supply curve. But because costs increase, that means that firms aren't going to be able to produce as much. So they're going to have to cut back on supply. And short run aggregate supply curve is going to shift to the left. And in the end, we're going to be left with a point where we're going to be at a higher price level and GDP to be the same. Um, and then uh, I'll just do this one here real quick. Suppose that the economy is at long run equilibrium. If there is a sharp rise in stock market combined with significant increase in the minimum wage, and in the short run, what will happen? So if there's a sharp rise in the stock market, then that means that aggregate demand is going to shift to the right. If there's a significant increase in the minimum wage, remember that's going to increase the cost for producers. So that's going to mean that the short run aggregate supply curve is going to shift to the left. And we know that the price level is going to rise regardless, but real GDP might rise, fall, or stay the same, depending on how much of the aggregate demand curve shifts and the short run aggregate supply curve shifts. Um, so I will hand it off over to Alex and he can go over 21.
Okay, yeah. So to wrap this thing up, we're going to talk about chapter 21. Like Justin, I prepared little notes, just going a little bit about the main concepts of um, about fiscal and monetary policy. So, what is chapter 21 really about? It shows the tools that government and Federal Reserve have at their disposal to decrease aggregate demand. Um, at the moment, we're living in that time. At the moment, with COVID, the Federal Reserve Bank and the government have been doing everything they can to keep aggregate demand high. So, if there's a time where this is really, um, really, when you should know about this, it's right now. So, what do we have? We have fiscal and monetary policy. Fiscal policy is either tax cuts or tax increases. and just government spending in total. Increasing government spending through stimulus checks or decreasing government spending. Monetary policy is increasing or decreasing the money supply, and I'm going to show you how you do that, and setting the interest rates. At the moment, the interest rate is almost zero. So that's also an example, and we're going to talk about this chapter and how it somewhat relates to what we're living in today, right now, in the times of quantitative easing after the COVID recession. Three effects um, of the aggregate demand. There's the wealth effect, refers to price level. Um, when you have this graph, and there's the interest rate effect and the exchange rate effect. So through these tools above, one of these three effects take place, which in return increase or decrease the aggregate demand. These three effects will increase or decrease, like I just said. So basically what I'm trying to say is that the government and the central bank, they have the tools through fiscal and monetary policy that set up one of these three effects. So these tools set up these three effects. And for example, the interest rate effect is, you can see that's one-to-one, but some of these effects like the exchange rate effects or the wealth effects, they're not direct, they're indirect effects of some of these tax cuts, which ultimately increases or decreases aggregate demand. Um, then there's also now I'm talking about monetary policy. That's what the Fed can do by increasing or decreasing the money supply. So either they set the interest rate, they change the interest rate, it's low, and they increase the money supply, or they change the money supply by buying or selling government bonds, and that is referred to as as monetary policy. And we're going to also look later how monetary policy is used to stimulate the economy. And then, like I said earlier, fiscal policy is just going to be changes in government spending and changes in taxes. So that's like a very brief overview of like what we're actually doing in this chapter. So number one, when the interest rate increases, the opportunity cost of holding money increases, so the quantity of money demanded decreases. So I just basically put this in layman term. When interest rates are high, people leave their money in the bank, because if you leave your money in the bank and you get a lot of percentage returns with like barely any risk because you're just leaving the money there. It's not like the stock market. There's no risk of it plummeting down, or at least less risk. Or it's not like investing in other stuff. Then you're just going to be like, okay, I'm just going to leave my money there. I'm not going to touch it because the money is just going to basically increase. So that's why the opportunity cost of holding money increases. Now let's look at number 4, which is a very not tough one, but like very mathy question. So you basically just have to know these two formulas. We're going to go over them a lot. It's basically the first formula is the marginal propensity to consume, and then the second one is basically just calculating this missing variable. So the first thing you have is, oh, sorry, I didn't show you the question. I meant number 5. Yeah, so we basically are given, yeah, I didn't have a room down here, so that's why I basically put it down here, but this is number 5. So we're given when income is $1,000 and consumer spending is 800, the value for the multiplier of this economy is 2.5. It follows that when income is 1,020, consumer spending is, and basically what you're trying to calculate is this missing spending variable. So the first thing you need to do is, given the money multiplier here, you want to calculate the marginal propensity to consume. So that's basically what I'm doing here in this section. I'm basically taking the multiplier equals 1 divided by 1 minus the marginal propensity to consume. When you solve this, this expression down here with one missing variable with some simple algebra, when you solve that for 1, you get the MPC of 0.6. Then basically what I'm saying is I plug this into here, and and we are given spending 0, which is basically 800, and we're given income 1, which is income 0, which is 1,000, and we're giving our income 1 here 1,020. We're just missing this part. So you again plug everything you have in here, and you solve again for one variable, which gives you spending is 812. And then we can basically eliminate those two choices. Then we have those two choices left, 812, and an initial increase of 100 in consumer translates to a 250 increase, because remember, we said the multiplier is 2.5, so 100 times 2.5 equals 250. So that's why the answer here is going to be C and not D. So then number 6, to reduce the effects of crowding out caused by an increase in government expenditure, the Federal Reserve could. This is an example of how the Federal Reserve increases money supply by buying bonds. So imagine this part here as the money supply. Imagine the money in circulations, and this is the Fed. And then number 7 is the marginal propensity to consume for this economy is, here it's again the same formula. You have the MPC, which is the change in consumption and change in investment, where you have given, spending 1 and spending and income 1 and consumption 1, income 1, income 0. Just like this refers to the difference. Also the 1 and the 0 don't really matter, because it's going to give you the same values. The difference is going to be the same, just in this case it's negative. But if I put this 7,040 and 8,050 first, doesn't matter, it's still going to give you this 0.64. Then refer to scenario 1, the multiplier for this economy is, remember we just said that the marginal propensity to consume is 0.64. So you just do 1 divided by 1 minus 0.64 here, and it's going to be 1 divided by 0.36, and that's 2.78, like we did up here, kind of how you see how this is related. And number 9, as GDP falls, what happens? The money demand falls. And as you can see, the money supply is untouched, and the interest rate will fall, because think about it like this: when GDP falls, then like during COVID or during like times of depression or recession, people will not want to like go out and spend all their money. They're going to probably try to just save and stuff, and there's not really that demand for money. Well, imagine there's like this time when we're in the boom and everyone's like, yeah, I want that money, I want to invest my money, I want to build, I want to spend. So that's why the interest rate will actually go down just by the GDP falling and money demand. This is the crowding out effect. Which of the following sequences? Remember that y equals c plus I plus g plus nx. Actually, let me say plus exports. One is imports. Is the equation for aggregate demand. And we're basically, again, saying that the government is trying to increase the demand for money by by doing these government purchases. So if this G increases, the demand for money increases. So the opposite of here, it would be basically that this curve shifts up here. And then the equilibrium interest rate, however, would increase, as you can say up here. But then the quantity of goods and services demanded would go down as a result of this higher interest rate. So what the crowding out effect basically saying is that even though the government is trying, with this expansionary fiscal policy, spending a lot of money, they're trying to, boost the economy, that will lead to this higher interest rate, which will like dim down the effects of this like boost, if that makes any sense. And so they're crowding each other out. So this more spending will lead to higher interest rate. It will not do as much anymore based on this graph. So that's why this is the answer to this question. Also, chapter 11 is just a present, so the multiplier for change in government spending, yeah, 1 divided by 1 minus MPC. This is kind of the reverse to what we just saw here. That suppose that businesses and consumers become much more optimistic about the future of the economy. To stabilize output, the Federal Reserve could sell bonds to raise interest rates. So they basically want to decrease the money supply, um, which in return would make the interest rates go up. And how do they do that? They sell bonds, which means that investors will give their money to the Fed. That means the general public has less money, these people, which is basically the money supply. And they get these bonds, or as a result, if they say, hey, here, buy bonds and give me your money, they're going to keep that money and they're going to keep it. But that's not more in the money supply. As a result, this is going to go left. And when money supply go left, then the interest rate increases. That makes somewhat sense. Also here, um, it says the aggregate demand curve could shift from 81 to 82 as a result. So as you can see, the aggregate demand is falling. This, if you remember aggregate demand and aggregate supply from what like Justin told you, but here I tried to do it kind of the mathematical way. So we're basically asking, how can you make this y go down? Basically, this curve shift just tells you that this y, this expression went down. So basically, it could be by decreasing exports, by decreasing investment, by decreasing government spending. All of those would make it go down. However, also remember the exports minus imports. So if exports go down, and X will go down, and Y will also go down. And looking at these answer choices, you use process of elimination. Increasing government purchases would increase that. Do you see? That would go up. That would make Y go up. That would make this curve go right. So that's wrong. Also, saving a small fraction of their income. That would also not. I would assume that would actually make this. No, that would make this go up because they're saving a smaller fraction, they're actually spending more. So that would also make this go up. And a decrease in the price level would be a result. But it's not like you can say, okay, I'm going to decrease the price level. Like, no one can be like, okay, let's decrease the price level. It's like it comes as a result of something else. So this might be the answer here. And that's honestly everything I prepared for this chapter. Yeah, so thank you for this semester and good luck on the final, guys. Unless Justin has anything, I'm pretty much think I'm good.
No, no, I'm fine. Like I said, if you have a question, feel free to email Alex or myself. But no, yeah. Other than that, hope you do well in the final, and yeah. Um,
Thank
I don't
you.
know if